After my recent CPF Life video, I had some of you guys reaching out to me with various questions such as whether you can top up your retirement account to any number between the full retirement sum and the enhanced retirement sum, to what happens when we turn 55 and still have a housing loan. So I've done my research, and in today's video, I'm going to attempt to answer all these questions and more in one go so that you know what's exactly possible and what's just a misconception. I know that your time is valuable, so these will be the questions and misconceptions that I will be going through in today's video, and with that said, let's go. And if you're new to my channel, my name is Darren and I'm on a journey to understand CPF, saving accounts and personal finance, and I basically just share what I learned along the way via this YouTube channel so that we can all make better money decisions together. So if these topics interest you, then consider subscribing to my channel and join me on this journey. Okay, so the first two questions comes from a viewer who first wants to know if we can top up our retirement account to any number between the full retirement sum and the enhanced retirement sum, say $300,000, or it has to be exactly the full retirement sum or enhanced retirement sum. And his second question is, what's the benefit of topping up the retirement account as compared to saving that money in fixed deposits or some mid-risk investments? Let me address the first question, which is, can you top up your retirement account to any amount between the full retirement sum and the enhanced retirement sum? And the answer to this question is, it depends on your age. Basically, if you are age 55 or above, you will then have the option to top up your retirement account up to the current year's enhanced retirement sum as retirement becomes an even higher priority. However, if you are aged below 55, then you can only top up your special account up to the current year's full retirement sum. And once you reach the age of 55, you can then choose to set aside more in your retirement account up to the current year's enhanced retirement sum. In fact, you can easily check your top-up limit in the top-up sections of your retirement dashboard, where it will state for those of you below the age of 55, the maximum amount you can top up using cash to reach the current full retirement sum. And if you are 55 or above, then it will state the maximum amount you can top up using cash to reach the current enhanced retirement sum. Let's now address the second question, which is, what is the benefit of topping up the retirement account as compared to saving that money in fixed deposits or some mid-risk investments? To answer this question, let's take a look at the current CPF interest rates. And we can see that the current retirement account's interest rate from the 1st of July to the 30th of September is 4% per annum. Hence, this is how I see it. By topping up your retirement account, you get to earn a risk-free 4% interest. And at payout age, this gives you a lifelong monthly income via CPF Life. For me, the downside to topping up your retirement account is that funds are locked in until payout age. Hence, you lose that liquidity. Let's discuss the alternatives, such as fixed deposits. As of now, one-year fixed deposit rates are not exactly high. Just take a look at Maybank's one-year fixed deposit promotion. It's only 1.45% per annum. Not to mention the fact that fixed deposit rates can change. And from the way I see it, rates are only starting to come down. But placing your funds in a fixed deposit does give you liquidity after maturity. So in a way, it's more liquid. But then there is no lifetime payout, so you need to manage the funds yourself. Of course, we can place our funds into mid-risk investments such as bonds, REITs, and balance funds. These can give you potentially higher returns. For this option, liquidity is generally better as you can sell these whenever you need the funds. But as with all investments, their market value can fluctuate, and there is always a chance that the market tanks just before you need the money. So if you were to ask for my opinion, topping up your CPF retirement account is a good idea if your goal is to achieve secure retirement income once you reach the payout age. Fixed deposits, they are more for short-term parking of funds where you get to enjoy a slightly higher interest as compared to just putting your funds into a normal bank account. And mid-risk investments, well, they are more for growth, but these can come with volatility, and these require discipline and risk tolerance. And if these two questions help clear your doubt, then drop me a like. This helps the channel and tells me to keep making more CPF videos like this. Let's now address the third question. What is the payout for the three plans from 65 to 80 assuming full retirement sum? So for those of you turning 55 this year, your full retirement sum is $213,000. And in case you do not know, CPF has a monthly payout calculator for you to use, and I will be basing my calculations on this calculator. Hence, for a person who is born in the year 1970 with the full retirement sum and choosing the basic plan, then at the age of 65 and 85, he will be expected to join CPF Life with $315,000 and be expected to receive around $1,560 a month after the age of 65, and from the age of 95 onward, he will be estimated expected to receive around $1,480 a month. Let's say he decides to start receiving payouts at the age of 70, then he will be joining CPF Life with $390,000 and his monthly payouts will increase to around $2,080, and this payout should drop to around $2,030 from the age of 95 onwards. Let's say he chooses the standard plan instead and chooses to start his payouts at age 65. Then his expected monthly payouts would remain at $1,700 a month from 65 onwards and $2,290 a month from age 70 onwards. Now let's say he chooses the escalating plan and decides to start receiving payouts at the age of 65. Then his expected monthly payouts are $1,340 from the age of 65, $2,000 from the age of 85, and $2,440 from the age of 95. And if he chooses to start receiving payouts at the age of 70, then his expected monthly payouts are $1,850 at the age of 70, $2,490 at the age of 85, and $3,040 from the age of 95. The fourth question is more as a request where a viewer wants to know how do the three CPF Life plans contribute to the common pool interest. This is directly from CPF's website. So basically, risk pooling is used in CPF Life as well as other annuities and insurance plans to spread risk among participants. And the interest from your CPF Life premiums are then pooled with other CPF Life members and are factored into your retirement payout when you are alive. And after your death, the interest on your CPF Life premiums that have not been paid are then pooled with other surviving members to ensure that they can receive monthly payouts for life. Now let's move on to the fifth question, which is with CPF Life, will you make more money if you pass away early or if you live a long life? To answer this, we have to first understand that CPF Life provides us with a monthly payouts no matter how long we live, and upon a member's death, any unused premium is then refunded to the member's beneficiaries. So if you pass away early, then your estate just gets back what's left of your premiums, whereas you loogie in the sense that you only enjoy a few years of payouts. But if you live longer, then you can potentially get more than what you put in, but your death benefit will reduce and be close to zero if you live very long. Here is an example. Let's assume one is 55 years old now with $213,000, which is the full retirement sum for 2025. Assume he wants to start receiving his CPF Life payouts at the age of 65. This will mean joining the program with $315,000. Now, if he were to live till the age of 85, which is 20 years from now, then the total amount received will be $1,700 times 12 times 20 years, and that works out to $408,000. And if he were to live till the age of 95, which is 30 years from 65, then he will receive $1,700 times 12 times 30 years, and that will be $612,000. However, if one were to pass away shortly after receiving payouts, then CPF will just return any unused premiums back to your beneficiaries. So in short, the longer you live, the more money payouts you will receive. So I guess please stay healthy, yeah? The sixth question posed to me is, what happens when we turn 55 and still have a housing loan? Okay, I'm sure by now we are all of the understanding that on our 55th birthday, a retirement account will be created for us and savings up to our full retirement sum from our special account and ordinary account will then be transferred to this newly created account. Hence, any remaining balance in our ordinary account can then be used to pay for our existing home loans. But what if money in our ordinary account gets wiped out? Then our home loan how? Don't worry, friend, because you can actually apply to reserve your savings in your ordinary account before your 55th birthday. This is from CPF's website, and you can see that you may apply to reserve all or part of your ordinary account for housing payments within 6 months before your 55th birthday. By the way, guys, if you currently still have a housing loan, it's worth checking out if you are paying too much interest. I've partnered with CashU, an online mortgage brokerage website that helps you compare the home loan rates across all banks. This works for both new loans and refinancing, and the best part, it's completely free to use. All you need to do is sign up for a free account and you will get instant access to all the latest home loan rates. Click the link down below or scan the QR code over here to sign up for free. Just so you know, all sign-ups help support this channel at no cost to you. Let us now tackle some common misconceptions about CPF Life that many people get wrong. So misconception number 1, my CPF Life premiums do not gain any interest. This is not true. Your CPF Life premiums will continue to earn 4% base interest and up to 2% extra interest on the first $60,000 of your combined CPF balance. This interest is factored into your monthly payouts, allowing you to receive higher monthly payouts from the start and for as long as you live, even when your CPF Life premiums have been depleted. Misconception number 2. My CPF Life premiums will be distributed to other CPF members after my death. So if you pass away before your CPF Life premiums is depleted, your beneficiaries will always receive any remaining unpaid CPF Life premiums together with any remaining CPF savings. However, the interest on your CPF Life premiums that has not been paid to you, well, that is pooled and goes towards providing money payouts for surviving CPF Life members. Guys, I sincerely hope that this video gave you more clarity on how CPF Life works. If you found this video useful, do share it with a friend who might benefit. And if you enjoy learning about CPF savings and personal finance, then do consider subscribing to my channel as well. See you in my next video.